So thank you, everyone, and welcome to this week's speaker series. I'm happy to be joined today by Benoit Anne from MFS. Benoit, thank you for joining us today.
Hello, everyone. So let me talk about how I would discuss the outlook for fixed income and in particular credit. I'm actually quite constructive on credit at this point in time, and for maybe three main reasons, right? The main reason number one is the macro environment is much more supportive of credit. Why is that? Well, let's talk about growth. Everybody is obsessed with recession in the US. Is there going to be a recession or not? Well, guess what? I'm not nervous at all. If there's indeed a recession, it's going to be a very mild one. And in fact, it looks like the case for soft landing is looking better and better. So we might actually see no recession at all, which obviously is really good for risky assets. And why would that be the case? Well, I would like to say this business cycle has been weird. It's not your typical business cycle. So all the relationships that people were talking about, they don't work anymore. There are a few weird things that have confused market participants, and therefore that soft landing that nobody saw coming is now a strong possibility. I'm going to give you a few examples. That typically under recession, the labor market adjusts through a spike in the unemployment rate. It's not happening. What's going on right now is it's the job openings that are adjusting, not the unemployment rate. Another thing is the economy is actually much less vulnerable or sensitive to interest rates. Back in the day, a higher interest rate would do a lot of damage, but that's not the case anymore. Why? Well, the consumer is much less levered, right? So the consumer debt is much lower than it was before. The corporate sector, talking about credit, the duration of the index has extended by quite a bit. So it's actually less painful now, that interest rate shock. And I would also argue, if you look at the structure of the US economy, the share of the sectors that are highly sensitive to interest rates, like housing and all that, the consumption of durable goods, that share has gone down over time, right? So overall, we are in a very strong position, and I really positive on the growth outlook, and that helps the case for credit. What about inflation? Inflation was the big deal last year, right? Now disinflation is well on the way. It's actually looking pretty good. Even housing, which was the lagging part of the inflation picture, is now catching up, and we are seeing rents going lower and house prices going lower, and that is going to feed into the official data, and we end up with an inflation number, which is already, by the way, in the low threes, right? The headline. The core inflation is a bit stickier, but also moving lower. So the inflation picture, I think, is gone now. So I've talked about growth. I've talked about inflation. What about rates? Well, rates, we've seen that correction over the past few weeks. We've obviously had a big correction last year. I would say the correction this year is for the right reasons, not for the wrong reasons. And again, back to my earlier point, why did rate go up? Because the outlook for growth has been upgraded. So it's a good reason for rates to go up. But now they've gone up enough, I would say. We've reached a high level, and it's actually very positive for credit and spread products. Why? Because your starting yield is much higher, and that does provide a lot of protection from the valuation standpoint. So I'll talk about that in a bit as well. So growth looking good, inflation, disinflation on the way, rates view, I would say the risk of a sharp upside to rates at this point in time is very limited because we've seen a big correction already. Central banks, we shouldn't be scared about the Fed anymore. The Fed is done, right? So the Fed is going to disappear in the picture, right? After being the main actor of turbulence and stress for the past few quarters. The Fed is going away. So that opens the door for a risk appetite, for a much stronger market backdrop, and for deploying credit risk. So that was my first point.
Let me ask you here. Let me interrupt 1 second and say, so I agree with you that the sort of overall the outlook, especially in the near term in the U.S. has improved. It stays strong. I wouldn't necessarily say that it has improved, but it has definitely stayed strong. It has stayed strong than a lot of people thought. But let's talk about those inflation numbers, because you said that the Fed is done, and we tend to share your view, but we do think that there's also some risk that the Fed could potentially have to start either a new hiking cycle. It's not our base case. It doesn't sound like it's your base case either, but there is a risk, and or remain at these rate levels for an extended period of time, right? And some of the repricing that we've seen in markets here in August and in the first few days of September have been directly tied to some stronger, let's say, pricing data that has come in, right? We saw the ISM services paid number came in stronger than expected. We even saw some employment data improve on that survey. We've also seen some stickier numbers out of Europe. So it's not just a US story, it's also a Europe story. How are you thinking about some of these risks? Do you see them as substantial, immaterial? Talk about that a little bit.
Yeah, great point. So the second scenario you're describing, Hamed, is not a risk for me. It's actually a best case scenario. I don't mind rates staying stable for a longer period of time, because that is going to kill rate volatility, which was a very toxic development last year. And the Fed will ultimately normalize its monetary policy down the road, starting maybe right now we're in highly restrictive territory, and that cannot be sustained forever. So even though there will be no recession, the Fed is going to gradually reduce its policy rate. The fact that rates are staying high for longer, well, I've observed that the US economy can actually take it. Are we seeing a sharp rise in defaults? No, it's the high yield sector is actually behaving quite well. Are we seeing issues with earnings and corporate profit? Actually, still surprising to the upside. There's a lot of strength here and lots of resilience. So that's not a risk. Your first point, though, yes, that would be 2022 playing out again, and that's my nightmare scenario. So yeah, it's that to me is a low risk. But if the Fed we're going to send signals that guess what, we need another tightening cycle, whoa, that's a serious tail risk there. But I don't see that coming, because inflation is a lagging indicator, right? The Fed is watching a lagging indicator. The Fed is actually looking at the rear mirror right now. It's driving, but it's focusing on looking backward. And even that variable that is lagging is starting to adjust. So that's actually good news. We're, I think, in pretty good shape.
Are you concerned with the sort of by many estimates, the excess pandemic savings in the U.S. will probably be wiped out by the end of this year, beginning of next year? Are you concerned at all with the durability of the U.S. consumer in that scenario, where their excess savings get spent away by the end of the year, beginning of next year? And also, something that's not talked about too much is that we've had a resumption of student loan payments in the United States. I've seen estimates as high as potentially 0.3, 0.4% of GDP that might be. It's basically a withdrawal of stimulus, right? Because it's a tax to a certain degree. It's income that has to be diverted to payments that had not been diverted to payments before. So talk about those two issues if you can.
Yeah, so to be clear, the good days of fiscal stimulus are behind us, right? So the economy is going to have to learn to be on their feet by itself. I think this is past. So yes, normalization of fiscal policy, a bit of a shock at the margin for student loans. Nothing too major that would create some turbulence. On the consumer side, still a lot of resilience. There's definitely some strength. If you look at the latest numbers of consumer spending, continue to surprise to the upside. That excess savings is going to disappear, but we're going to go back to normal. And normal for the US consumer, you know that better than me, is still buoyant consuming behavior. I know that because my wife is American and she visits the country very often, and I can see that consuming behavior in play right there. So definitely some buoyancy. I mean, anecdotal evidence. I spent 6 weeks in the US, East Coast, this summer. Do you feel the recession of the consumer? I didn't, right? It's definitely not there, and I don't think it's coming. So obviously there's the issue of disparity of income. Different income buckets will be affected in a different way, for sure, and that excess savings is going to be phased out. That's part of life, right? I mean, that's you could not. There's no way that ballooning stimulus was going to be sustained forever. But that's not a source of concern. I see so many other pockets of resilience, even capex. You know, if you think that the corporate sector will be in trouble, they would cut capex, right? Because that's easy to revise, right? So you see you're very negative on your profit outlook, therefore you're revisiting your capex plans. Those are still pretty healthy. So that's a very good sign.
Yeah. So we've talked a lot about the U.S. economic picture, which, like we've said, has been a source of positive surprise. Positive surprises has been, a surprisiness to the upside. But let's talk about Europe and let's talk about China, because those are two regions which have not been surprising to the upside. If anything, they've been surprising to the downside. What are the possibilities, or what's the outlook for you in Europe and in China?
All right. So in Europe, I think the only red flag is probably Germany, where obviously it's a big red flag. It's not just economy in the Eurozone, but everybody else is actually pretty healthy. A lot of strength in Spain, Italy, Ireland, the Netherlands, and even France is doing well. So as a region overall, I think the Eurozone will avoid a recession, which is quite remarkable. I do like European assets as well because they are cheap, but with the upside on the microphone, I think they're a good investment case. China, there are two ways to look at China, right? So the growth model, the structural growth model is broken. All right, the good old days of double-digit growth, that's all gone. The China is going to have to learn to live with growth in the area of 5%, more or less. And that means something very different. That means consumer-driven, inward-driven. But there are a lot of positive things in China, like investment in technology is super high, very, very impressive. Now, there is also trouble. If you look at corporate defaults, they have doubled from 1 year to another, right? In just 1 year, the volume of corporate defaults has doubled, mainly concentrated in the property sector. The property sector is, I wouldn't say the whole sector is dust, but a lot of large companies in that sector are really facing the heat. Now, one piece of comfort about China, and I would introduce the concept of policy room, right? So the authorities in China have a lot of policy room. They have the ammunition to address a financial crisis if that financial crisis arises. So I'm not concerned about China meltdown. Will China be a fantastic driver of economic growth at the global level? Not anymore. All right, so it's going to be much less coming from China. But that's part of growing up, right? It's like the economy is maturing.
Yeah, is China becoming Japan circa 1990?
I've heard that story, and some people say they should be lucky to feel that they're going to be Japan. I think that's a bit of a stretch. I think China can sustain a growth rate of 4 to 5%, and they continue to invest massively in technology and all those sectors. In fact, in sustainable investment as well. And that to me is very positive for the long term. So no serious risk of deflation, long-term deflation in China, the way I said.
Mm. Okay. Now let's shift over to the market and for investors here, because we all know that a very profitable trade has been to be purchasing short duration U.S. Treasury assets over the past 6 months, really, but probably even before then. Those who shorted duration or who were on the shorter parts of the curve definitely did well, especially on the fixed income side. Given your outlook, what are some potential alternatives out there for investors who want to venture out from the short parts of the U.S. Treasury curve?
So I think being relatively short on the curve makes total sense. So that part I agree with. But now I would want to deploy credit risk, as I said, because of the macro picture I discussed. So away from treasuries, go into short tenor credit. You pick up yield, right? You're talking about at the index level yields almost 6% for the 1 to 3 year US IG credit. That's very little credit risk. I mean, or little duration risk times credit, right? So it's not a risky asset class, right? You're talking about USIG with a short tenor, but you pick up a lot of yield from treasuries. And with that story that I'm rolling out, the end of the Fed tightening, the soft landing, which is a strong possibility, I don't see any risk of spreads really being wiped out, right? A sharp widening of spreads. And then you sit on a starting yield, which ultimately is the critical variable here. Your starting yield in fixed income, as you know, is going to be a key determinant of your expected return in the period ahead. So if you start off at roughly 6%, you're in pretty good shape. And I've crushed the numbers. Whenever you start at 6% for now, based on historical data, your median return over the next 5 years would be well over 5.5% every single year for the next 5 years, right? That's pretty good for fixed income, right? Will you outperform treasuries if you do that? I would say a really high probability that you will. Yeah, I've got to be careful what to say. I cannot say guarantee, but because compliance would like
what
that.
about those that are looking to extend duration? It sounds like you're focusing a lot on just adding credit risk, but on the shorter side. How about those that are looking to extend duration as well? I mean, if we are, as you said, if the Fed is done hiking rates, is the U.S. 10-year bonds at this point, it's a pretty attractive place to be at 4.25, 4.30 or so. I'm not sure what it closed today, around 4.25. But how do you see the duration side, the extension of duration trade?
Yes, and that's going to be a big theme. Totally agree with it. Just not now, right? Right now, I would be in the front end of the curve. I'm going to have to wait for that treasury curve to re-steepen, which will be coming. And when that happens, then there's going to be more value to extend down the curve, on the credit curve. One positive development is if you look at the shape of the credit curve relative to the shape of the treasury curve, it's actually much less inverted. So there's already a bit more value down the curve on the credit side. But is there enough value to pile onto the long end? I would say let's wait a little bit. I would want the US Treasury curve to re-steepen. That will push the credit curve even steeper, and then you've got the case for extending that duration. But it's more like let's call it probably late Q4, early Q1 next year. Yeah.
Okay,
Right
excellent.
now,
And
I still prefer the front end.
I'd like to remind everyone that if you have questions, please submit them via the chat or to me directly. I'd be more than happy to relay them. I see one question has come in, so we can go to that. The question is there a war economy benefiting Europe? Is there more GDP spending in France, Britain on armament?
Wow, that's a tough question.
Very
Uh,
specific question there.
yeah, I'm not quite sure. I definitely Germany, when the Ukrainian crisis broke out, they committed to higher military spending. I haven't picked that up in France. They're talking about cooperation and so on, but I don't think that's something top of the mind for governments at this point in time.
Okay. Are there any sectors that you would be looking to extend credit risk? Going back to the sort of your first viewpoint here to add on credit risk. Any sectors that you particularly like? Any countries that you particularly like? Any sectors that you would avoid? Any countries that you would avoid?
No. So the way we think about our investment process is there are good companies in every single sector. So it's not necessarily a sector view, but it's really a bottom-up security selection process that we do, and we identified opportunities in every single sector. So it's hard to sort of characterize by sector, but because even financials, right? Financials get a lot of bad press, a lot of headline risk. We actually like financials for certain specific names. In particular, in Europe, European financials are very cheap, and some of the names are quite attractive, and we are very constructive of them. But there would be European banks that we would want to avoid, right? So there's always going to be the security selection process, which at MFS we're very proud of, right? We've got an army of credit analysts and financial analysts looking at those names. I like emerging markets for those that have the appetite for it. I think the dollar is going down. It's the end of the strong dollar. Therefore, that benefits emerging markets. Global growth is actually being revised up. We talked about China maybe with a negative undertone earlier, but at the end of the day, the global growth picture is much better than we thought it would be a few months ago, and that usually benefits emerging markets. Fundamentals in emerging markets are pretty strong. Obviously, again, it's a matter of picking the right country. There are a lot of Latin countries that we like, yeah, Mexico, Guatemala, Paraguay. Looking at those opportunities, emerging market debt, you're looking at potentially, short of double-digit returns, right, for emerging market debt. So that's pretty attractive.
Right. On that note, there's a question here specifically if you have any opinion on higher quality, long duration EM debt. Your thoughts?
Yeah, as an asset class, I really like it. It's one of my top picks. I think if you look at, so I have valuation screeners across global fixed income, and emerging market sovereign debt is one of the cheapest asset class right now, and the fundamentals are very strong. If you look at the growth picture in emerging markets, outperforming developed markets, of course, but by a large margin. If you look at the external position of emerging markets, the balance of payments and so on, it's like really got stronger. And again, I would stress that the weaker dollar, which is coming after that summer bounce, that's also positive for emerging markets.
Yeah. We actually it's funny that you say this because I heard you mention Mexico. We're actually putting out a primer on Mexico tomorrow. We're publishing it tomorrow here at Insignia, where we're going to be looking at some Mexican bonds, equities, the Mexican peso, the economy there in Mexico. Maybe share your views on that. So if they differ too much from our views, our cafes could hear your views on that.
Yeah, so I spent many years at the IMF, so I care a lot about the credibility of economic policies. And if I had to single out one country in the emerging market that has credible policy framework, I think Mexico is one, both at the central bank level and at the finance ministry level. So pretty solid, very well managed economy there. Structural reforms, growth dynamics, nothing. Obviously, there's still a few issues. This is emerging markets, but I would say overall a pretty solid story.
Yeah, excellent here. So we have only a few more minutes here. Any sort of final thoughts, either on the macro side or the investment side, that you want to leave us with here?
Yeah, so I mean, I spent a lot of time talking about the macro earlier, and then we had a really good discussion. But also wanted to highlight that the valuation picture in fixed income is amazing, right? That's also a very strong argument here. If you look at the total yields, they are as attractive as they've been for the past 10 or 20 years. Obviously, compliments of that massive rate correction we've gone through. But that's a big deal. Why? Because again, it's your starting yield. So valuation of fixed income is spectacular right now, and I wouldn't miss it. It's really a call to action. The short-term credit in particular looks very attractive.
Excellent. So maybe finish us off here with a little bit of some details about your team and what you do over at MFS. So if our clients want to reach out or find out more information, where and how they can find it.
Yeah, so I'm part of the investment solutions team, right? And the mandate of my team is to precisely help the clients and to really be out there and help clients become a better investor. So that's my role. And I focus mainly on fixed income, but I have a multi-asset background, so I can tackle many topics.
Excellent. Sounds good. Well, thank you so much for joining us. And, we hope to be able to have you soon. Really appreciate that.
Thank you. Thank you.
See you again. Bye-bye. Take care. Insignia Financial Group, LLC, comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.